today's fast-moving financial world, the smartest investors aren't choosing between crypto and traditional markets. They're combining both. Imagine the long-term strength of ETFs, backed by blue-chip companies and sectors, fused with the explosive growth potential of blockchain technology and digital assets. That's the power of a well-balanced crypto plus ETF portfolio. In this episode of Smart Money Moves, we're breaking down how to build a future-proof portfolio that blends the best of both worlds. Whether you're aiming for steady gains or bold upside, we'll walk you through how to choose the right ETFs, how to pick high-potential cryptocurrencies, and how to balance risk while maximizing long-term returns. This isn't just another investment strategy. It's a roadmap for financial freedom in a world where money is going digital. So if you're ready to take control of your future and invest smarter, not harder, don't forget to like, subscribe, and hit that bell. Let's get started. In a world where financial systems are evolving at lightning speed, investors are faced with a fundamental choice. Should you stay grounded in traditional assets like ETFs, known for their long-term reliability? Or dive headfirst into crypto, a frontier filled with innovation, volatility, and opportunity? In 2025, that question no longer requires a single answer. The smartest investors are combining both, merging the old with the new to create portfolios that are not only resilient, but positioned for exponential growth. In this video, we are counting down the 10 essential principles that go into building a smart, balanced crypto and ETF portfolio, one that can weather market storms and capitalize on future trends. Starting at number 10, it all begins with understanding your risk tolerance. This is the foundation upon which everything else is built. You can't construct a strong portfolio without knowing your personal limits. Risk tolerance isn't just about how much volatility you can stomach. It's about your financial goals, your investment timeline, and your emotional discipline. Some investors lose sleep over a 10% dip, while others barely flinch at a 50% crash. Being honest with yourself about risk will determine how much of your portfolio belongs in volatile assets like crypto versus stable, diversified ETFs. It also influences how often you trade, how you react to market headlines, and whether you're investing for the next 5 years or the next 50. At number 9, we come to the core satellite strategy. This approach has stood the test of time because it provides both stability and flexibility. The idea is simple. The majority of your portfolio, the core, is allocated to diversified, long-term holdings like ETFs that track broad indices or sectors. These are assets you buy and hold for years. They're reliable, efficient, and give you exposure to hundreds or even thousands of companies at once. Surrounding this core are your satellites. Smaller, more volatile assets that have the potential for higher returns, like cryptocurrencies. This model allows you to take calculated risks without jeopardizing your overall portfolio. It's a way of placing smart bets on the future while keeping one foot on solid ground. Coming in at number 8 is choosing your ETFs strategically. This is not just about picking a few random funds and hoping for the best. Smart investors look at the entire global economy and ask, where do I want exposure? US stocks are a must for most portfolios, and funds like those tracking the S&P 500 or the total US market give you broad access to companies driving economic growth. International ETFs can diversify your risk across regions, while sector-specific funds like technology or healthcare allow you to overweight areas you believe will outperform. Even bonds, often overlooked by younger investors, can act as a stabilizer during bear markets. The goal is to build an ETF base that's diversified, efficient, and aligned with your time horizon. At number 7, focus on blue-chip crypto assets. In the crypto world, hype often overshadows substance. Coins pump and dump. Projects rise and fall overnight. But two assets continue to lead the pack with unmatched dominance: Bitcoin and Ethereum. Bitcoin is often referred to as digital gold. It's scarce, decentralized, and increasingly adopted by institutions and even governments as a store of value. Ethereum, on the other hand, is the backbone of decentralized finance, NFTs, and smart contracts. It's not just a currency, it's an entire programmable platform. By focusing your crypto allocation primarily on BTC and ETH, You give yourself exposure to the most secure and battle-tested assets in the space. These aren't speculative tokens. They're foundational pieces of the future financial system. Number 6 is about adding altcoins to your portfolio, but doing so with caution and intention. Altcoins can offer outsized returns, especially in early stages of adoption, but they come with far greater risk. Most altcoins are experimental. They often depend on small teams, unproven technology, or tokenomics that collapse under pressure. However, if you've already built a strong base with Bitcoin and Ethereum, and you have a clear understanding of what an altcoin does and why it matters, allocating a small percentage, perhaps 5 to 10% of your crypto holdings, can add upside to your portfolio. The key is to treat altcoins like venture capital. Expect volatility, expect failure, but also recognize the potential for massive reward if you choose wisely. At number 5, consider using crypto ETFs to ease into the space, especially if you're not ready to custody digital assets yourself. Holding Bitcoin or Ethereum in a hardware wallet might sound intimidating. Crypto ETFs remove that barrier. They allow you to invest in crypto through your brokerage account, with all the familiarity of a traditional stock or mutual fund. These ETFs are regulated, often liquid, and can be held inside retirement accounts. They provide an accessible on-ramp to the digital asset space for those who value ease and compliance. They may not give you direct blockchain exposure, but for many investors, they're a safer and more convenient alternative. At number 4 is the discipline of rebalancing. A well-designed portfolio drifts over time. If Bitcoin triples in value while your ETFs grow by 10%, your allocation shifts. Suddenly, your portfolio is overweight in crypto and exposed to more risk than you intended. Rebalancing is the act of resetting your allocations to their original targets. You might sell a portion of your crypto gains and rotate them back into ETFs, or vice versa during a crypto bear market. Rebalancing isn't just about risk management. It also enforces a powerful psychological discipline: buy low, sell high. It helps you stay grounded during euphoric bull runs and gives you courage during deep corrections. Number 3 is about unlocking passive income through staking and yield. Unlike traditional stocks, crypto offers the opportunity to earn yield just for holding. With proof-of-stake networks like Ethereum, you can delegate or stake your tokens to help secure the network and receive rewards in return. The process is simple through platforms like Lido, Coinbase, or even native wallets. For more advanced users, decentralized finance opens up opportunities for lending, liquidity providing, and yield farming. But these strategies require caution. High yield often means high risk. In a smart portfolio, staking is a way to enhance returns on long-term holdings, not a replacement for security or due diligence. At number 2, you must factor in the impact of taxes. Crypto gains are taxable in most jurisdictions, and many investors make the mistake of treating it like tax-free internet money until the IRS or local tax authority comes knocking. Every time you trade, swap, or sell, you could trigger a taxable event. Even staking rewards may be classified as income. Meanwhile, ETFs held in tax-advantaged accounts can grow with minimal tax impact. A smart investor plans their asset locations carefully. You might hold crypto in taxable accounts but track your basis religiously. You might hold ETFs in Roth or IRA accounts to minimize tax drag. Either way, you must treat taxes like an active component of your portfolio, not an afterthought. Smart portfolios aren't built on hype. They're built on strategy, balance, and long-term thinking. If this video helped you understand how to blend the explosive potential of crypto with the stability of ETFs, hit that like button, subscribe, and turn on the bell, because your financial future deserves more than guesswork. Crypto brings the upside. ETFs bring the structure. Together, they create a portfolio designed to weather volatility and capture opportunity. But this is just step 1. Now it's time to dive deeper into asset allocation, rebalancing, and tracking long-term gains. So tell us, are you already combining crypto with ETFs? What's your strategy? Are you going heavy on Bitcoin and the S&P 500? Or diversifying across altcoins and global index funds? Drop your thoughts in the comments. We read every single one. And if there's a topic you want us to break down next, whether it's staking income, rebalancing tools, or hidden ETF fees, let us know. This channel is built for investors who want more than noise. They want clarity. Thanks for watching, and remember, build smart, stay disciplined, think long-term. We'll see you in the next video.